Welcome to the Deep Dive, where we unpack complex topics to give you a shortcut to being truly well-informed. Today, we're taking a deep dive into the critical world of anti-money laundering, AML, and counter-terrorist financing, CFT.
Yeah, a really crucial area.
We've got a stack of detailed notes from a key National Assets, or Money Laundering Prevention Act. It gives us a unique lens, really, into how these global regulations are put into practice on the ground.
It's a fascinating area because it sits squarely at the intersection of finance, law, and, global security.
Right.
Our mission today is to extract the most important nuggets of knowledge from this detailed source material, helping you understand not just the what, but the why behind these measures.
And what it all means for the global fight against financial crime.
Exactly.
Okay, so let's start with the undisputed heavyweight champion in setting global standards, the Financial Action Task Force, or FATF.
Yes, FATF.
For those familiar with the financial crime landscape, FATF is the world's money laundering and terrorist financing watchdog. But what exactly is its evolving role? Why is it so indispensable?
Well, the FATF was established way back in July 1989 by the G7. It's an intergovernmental body, and its job is setting international standards to prevent these illegal activities.
Right.
Think of them as the architects, kind of a coordinated global response to organized crime, corruption, terrorism. What's truly crucial, though, is their adaptability.
So they're not just setting static rules, they're constantly evolving, though.
Absolutely. Originally, they were just focused on money laundering, but their mandate dramatically expanded after 9/11 in October 2001 to include combating terrorist financing.
A big shift.
Huge. And then by April 2012, they added efforts to counter the financing of proliferation of weapons of mass destruction.
Wow.
And they constantly review new criminal techniques like addressing virtual assets as cryptocurrencies became popular, and they strengthen their standards accordingly. And
They hold countries accountable, too.
yes, that's a vital part. Holding countries accountable for actually implementing these standards effectively.
Okay, let's unpack the core offenses themselves, then. What exactly constitutes money laundering according to this act we're looking at?
Well, this act defines money laundering quite broadly, which is key. It includes things like concealing or disguising the illicit origin of assets, converting or transferring assets obtained from a crime to protect the person involved from, legal consequences.
Right.
Or simply possessing, acquiring, or using such assets knowing or having reasonable grounds to know they are illicit.
Okay.
And it also extends to anyone who abets, facilitates, coordinates, encourages, or supports these acts. It's quite comprehensive.
Assets obtained from commission of offense sounds like the root of it. What kind of underlying crimes are we talking about here? Is it just the big financial stuff?
This is where it really highlights the pervasive nature of illicit finance. The notes give this remarkably extensive list of predicate offenses.
Predicate offenses.
Yeah, these are the original crimes that generate the dirty money. And it's definitely not just your typical financial crimes like fraud or market manipulation.
So what else?
This act includes everything from organized criminal groups, terrorism, human trafficking, sexual abuse, narcotic drug trafficking,
Wow.
to arms and ammunition trafficking, corruption, environmental crimes, even crimes related to ancient monuments, election fraud. The list just goes on.
That is extensive.
The sheer breadth is critical because it means virtually any serious illicit activity that generates funds falls under the AML net. It closes potential loopholes for criminals, you see.
Right. It makes sense.
Yeah.
So once that dirty money is generated, what's the classic process criminals use to clean it?
Well, the notes outline that universally recognized three-step process, which criminals try to obscure at every turn.
Okay.
First is placement. This is actually the riskiest step for criminals introducing those illegal profits into the legitimate financial system.
Like stuffing cash into a bank account.
Exactly. Or buying easily transferable assets. Then comes layering. This is where the complexity kicks in. It involves a series of conversions or movements of funds to distance them from their source.
Sort of like a money washing machine.
You could almost picture it like that, yeah.
Right.
But instead of one cycle, it's put through dozens, jumping between accounts, countries, shell companies, trying to erase any trace of its dirty origin.
Okay. Makes sense. And the third step?
Integration. Finally, the layered funds re-enter the legitimate economy, often through investments, real estate, luxury purchases, and now they appear to be legitimate.
So it looks like clean, earned money.
That's the goal, precisely.
That makes the process very clear.
Mm-hmm.
But what about terrorism financing? Is that just, giving money to a known terrorist group, or is it more nuanced?
It's significantly broader, actually, and often more challenging to detect than money laundering because the funds themselves might not be illicit in origin.
Oh,
The Act states that no person shall willingly, directly or indirectly, make available, provide, or collect funds knowing they will be used for a terrorist act or by a terrorist or terrorist organization.
knowing is the key word there.
Yes, and what's fascinating here, and a crucial distinction, is that it's considered an offense even if no terrorist activities actually happen.
Really?
Yes, even if the funds are not ultimately used, or if the activities or persons are abroad, or even if the funds supplied were obtained from illegal sources themselves. The intent to finance a terrorist act or organization is enough.
That's a very broad definition of intent.
It has to be effective.
This raises an important question then. What are the implications for entities like banks or, well, any financial institution if they get caught up in this?
Oh, for any entity, the risks are immense. You've got reputational damage that can erode public trust almost overnight.
Yeah, that's huge.
Operational disruptions, compliance failures leading to intense regulatory scrutiny, severe legal consequences, including massive penalties, and significant financial losses. Non-compliance is simply not an option in this landscape.
So, to combat these sophisticated crimes,
Yeah.
you need a robust, interconnected system. Our notes describe several key bodies that form this architecture. Can you walk us through how they fit together?
Absolutely. This framework from the specific act we're looking at involves several interconnected entities working in concert.
Oh.
First, there's the Coordination Committee. This body plays a high-level strategic role. It coordinates these interrelated entities and provides essential suggestions to the national government for MLTF prevention.
So very high-level policy direction.
Exactly. It's composed of top officials, secretaries from ministries like finance, law, home affairs, the central bank deputy governor, police chiefs, things like that.
Got it.
Their functions are broad: preparing policy, coordinating risk assessments, implementing government decisions, recommending international standards, and monitoring compliance across the board.
Okay, who else?
Then you have the Financial Information Unit, or FIU. This is the Central Intelligence Hub. Often it's an autonomous unit within the central bank, responsible for collecting and analyzing information related to money laundering and terrorism financing.
The FIU. So they're the ones getting all the raw data, the reports.
Precisely. They're the first line of defense in processing that raw data. They receive what are called threshold transaction reports.
For large transactions.
Yes, large transactions and suspicious transaction reports.
Okay.
They analyze these reports, then they disseminate actionable analysis to investigation agencies if ML or TF is suspected.
Makes sense.
They also provide crucial training to the reporting entities, the frontline we'll talk about next, and they exchange information with foreign counterparts, recognizing the cross-border nature of these crimes.
Right. And can they ask for more info?
Yes, they can also request additional documents and information from reporting entities or other agencies as needed for their analysis.
Okay, so once the FIU flags something, who does the actual, boots on the ground investigating?
That would be the Asset Laundering Prevention Department. It's established specifically for the investigation and inquiry of offenses under this act.
So they're the investigative arm.
That's right. And like the FIU, they can also cooperate and exchange information with foreign counterparts, which is vital, obviously, in tracing illicit funds across borders.
We keep hearing about reporting entities. Who are these entities on the front lines of this fight, and what are their core obligations?
This is a critical point that often surprises people. Reporting entities are defined really broadly. Yes, they include financial institutions, your banks, credit providers, money transfer services, securities dealers.
The usual suspects.
Right. But crucially, they also include non-financial professionals or entrepreneurs.
Non-financial, like who?
This category covers a much wider net. Casinos, real estate businesses, dealers in precious metals or gems, notary publics, auditors, accounting professionals, and even companies or trusts that provide services related to incorporating or managing legal entities, or acting as trustees or shareholders.
So it's not just traditional financial players at all. It's practically anyone dealing with significant financial transactions or assets. That's quite something. How does that extend the fight?
Exactly. It extends the net far wider. It recognizes that criminals don't just use banks, right? They funnel money through real estate, luxury goods, professional services.
Right, trying to find weak spots.
This comprehensive approach ensures fewer blind spots. Now, their core obligations are pretty demanding.
Okay, like what?
Well, first, a prohibition on fictitious names and shell banks. No accounts or transactions with benami or fictitious names allowed, full stop.
Makes sense.
Also, a strict prohibition on operating shell banks, banks with no physical presence, not part of a regulated group, or even having business relations with them.
Why are shell banks such a focus?
Because they are classic tools for concealing ownership and facilitating illicit financial flows, tax evasion. They're a major red flag.
Got it. What else?
Know your customer, or KYC. This is paramount. It's the fundamental first step in building that wall against illicit funds.
KYC. Everyone hears about it. What does it involve here?
Reporting entities must identify customers when establishing business relations, opening accounts, or conducting occasional transactions over certain significant thresholds.
Like large cash deposits or real estate deals.
Exactly.
Yeah.
Large cash deposits, foreign currency exchanges, major real estate purchases, they all trigger reporting. They collect detailed personal and business info, identity docs, nature of business, details of senior officials or shareholders for companies.
And the info has to be reliable.
It must come from independent, reliable sources. Verification is key.
What if the customer is someone particularly high profile, like a politician or a senior official? Does that change anything?
Absolutely. That brings us to high-level persons, often known as politically exposed persons or PEPs.
PPs, right.
Reporting entities must have a robust risk management system just for identifying domestic or foreign PPs, and that includes their family members and close associates.
Why the extra scrutiny?
Because PPs, just by virtue of their position and influence, are considered at a higher risk of being involved in corruption or bribery.
Okay, so what do they have to do?
Before even engaging with them, they need permission from high-level management. They must adopt enhanced customer due diligence measures, we'll get to those, and continuously monitor these relationships.
Including where their money comes from.
Especially where their assets and funds come from, the source is critical.
You mentioned beneficial owners earlier. What does that mean in practical terms?
Right, beneficial owner. This concept is all about identifying the natural person, the actual human being, who ultimately owns, controls, or directs a customer or account, or who is the ultimate beneficiary of a transaction.
So looking past the company name.
Exactly. It's about looking beyond the legal facade of a company or a trust to find the real individual in control. It prevents criminals from hiding behind layers of complex corporate structures.
So it's not a one-size-fits-all approach to checking customers out. How do they tailor their scrutiny?
Precisely. It's a risk-based approach, or RBA. Reporting entities must identify and assess their own MLTF risks based on their specific business, their customers, the products they offer, the channels they use.
Okay.
And the level of customer due diligence, or CDD, that they apply depends directly on this risk assessment.
So they focus more effort where the risk is higher.
Exactly. It allows for efficient resource allocation while really focusing on those high-risk areas.
Could you give us a quick overview of the different levels of due diligence? Why do they matter?
Sure. There are three main categories reflecting those varying levels of risk.
Okay.
1, standard or normal CDD. This is for your typical low-risk customers. It covers basic identity verification and ongoing monitoring.
Right.
2, simplified CDD, or SCDD. This is allowed sometimes for customers identified as very low risk. Think maybe other supervised financial institutions or large public companies.
But not always.
Definitely not always. This simplified approach is never allowed if there's any suspicion of MLTF, if the customer is high risk or a PEP, or maybe for customers from countries known to be non-compliant with FATF standards.
So strict limits on simplification.
Very strict. The idea is to reduce friction where risk is demonstrably low, but never at the expense of vigilance.
At the third level.
Enhanced CDD, or ECDD. This is for high-risk and medium-risk customers. It means additional, much more intense scrutiny.
What does that involve?
It involves deeper checks on customer identity, really digging into the source of income and wealth, analyzing the nature and value of transactions.
And when is it mandatory?
ECDD is mandatory for high-risk customers, anyone conducting complex or unusual large transactions, or transactions with no clear economic purpose. Obviously, for PPs and their associates, customers needing special monitoring, or those using high-risk products or services like, say, private banking.
So it's a deep dive into the customer.
It really is. It requires measures like truly understanding the customer's business purpose, their expected activity patterns, confirming the source of funds, maybe even reviewing local media reputation or commissioning intelligence reports. It's a full spectrum investigation, basically.
And how does this framework adapt to new technologies or transactions where you're not sitting across from someone like online banking?
That's a really important point. The Act mandates that reporting entities assess MLTF risks related to new or developing technology, new products, new business practices, or non-face-to-face customers before they launch them.
So they have to think about the risks upfront.
Yes, proactively. They must then take adequate measures to manage those specific risks, understanding that new channels inevitably present new vulnerabilities.
And non-face-to-face covers.
Things like internet banking, telephone, fax, post, ATMs, mobile banking, prepaid cards, anything where you're not physically present. And special attention is also paid to wire transfers and cross-border correspondent banking.
Why those specifically?
Because these are classic avenues for moving illicit funds quickly across borders. So for wire transfers, specific originator and beneficiary information must be identified, verified, attached to the payment message itself, and kept for 5 years.
Even the banks in the middle.
Yes, even intermediary institutions have to ensure this information travels with the wire. For correspondent banking, where one bank provides services to another, institutions must identify and verify the respondent bank, understand their business, their controls, evaluate their reputation,
And get approval.
and get senior management approval. And crucially, they must not enter into or continue relationships with those shell banks we talked about.
Okay, so once these relationships are established and funds are moving, how are ongoing threats detected? What's the system for spotting a red flag later on?
Right. It's not just about the onboarding. Reporting entities are required to conduct special monitoring of certain transactions.
What counts as certain transactions?
This includes all complex, unusual large transactions, unusual patterns of transactions, or any that seem to have no apparent economic or lawful purpose.
So things that just don't look right.
Exactly. They have to rigorously examine the background and purpose of these transactions and keep detailed records. Again, for 5 years. This continuous vigilance is essential to catch evolving criminal schemes.
And if something suspicious does come up, if a red flag is raised,
That's when suspicious transaction reports, or STRs, come in. Reporting entities must submit an STR to the FIU.
how quickly?
Usually within 3 days, according to this act. They file if they suspect a property is related to money laundering or terrorism financing.
What kind of suspicion triggers it?
It includes transactions that appear to conceal illicit origins, lack economic rationale, are unusually complex, deviate significantly from a customer's typical profile, or seem designed just to evade reporting requirements.
Like structuring cash deposit.
Precisely. And they must also report attempted transactions. Even an attempt indicates intent, you see.
Are there any other required reports? Perhaps for large transactions that aren't necessarily suspicious.
Yes, exactly. There are threshold transaction reports, or TTRs.
Threshold reports.
Yes, these are for aggregate cash transactions exceeding specific amounts within usually 1 working day.
Okay, like what sort of amounts?
Well, in this particular act, banks report deposits or withdrawals of 1 million rupees or more, or foreign currency exchanges of 500,000 rupees or more.
And for other entities?
Real estate businesses report purchases or sales of 10 million rupees or more. Casinos report chip purchases or sales of 200,000 rupees or more.
But different thresholds for different sectors.
Right. And while these specific amounts are from the act we're examining, similar robust financial reporting limits are common across jurisdictions worldwide. It casts a wide net over high-value transactions, whether they look suspicious initially or not.
What happens if a reporting entity doesn't comply with all these rules? Or maybe encounters a problematic customer who just can't provide the right info?
Okay, first, if a customer cannot provide the required identification, or the information they give seems conflicting or dodgy, the reporting entity simply shall not establish or continue a business relationship.
They have to walk away.
They have to terminate the relationship, and they may well inform the FIU about the attempt. Now, for broader non-compliance with the act, the regulators, the bodies that oversee these entities, have significant powers. They conduct supervision, they issue directives, and they can impose a range of really severe sanctions.
Such a?
Written reprimands, substantial fines, we're talking hundreds of thousands up to potentially tens of millions of rupees, depending on the entity type and the severity of the breach.
Wow, serious money.
Oh, yes. They can also impose restrictions on business operations or even suspend or revoke licenses or registration entirely.
So the message is clear.
Yeah.
Compliance is absolutely non-negotiable.
Absolutely. The stakes are too high.
Okay, so once a potential crime is flagged, maybe through an STR or a TTR, how does the investigative process actually begin? And what powers do the authorities have to pursue it?
Right, the investigation phase. It can start with a complaint from any person, and this can be kept confidential, which is important.
A whistleblower, perhaps?
Could be. Or it could even start if a staff member within the department itself suspects an offense based on information they have. A preliminary inquiry is conducted first.
To see if there's smoke.
Kind of. And if reasonable grounds exist, an investigation officer is appointed. Sometimes they might even form a joint team from multiple agencies if it's complex.
And their powers. You mentioned they were extensive.
They are remarkably extensive. They can order any agency or entity to provide documents and information relevant to the case. They can conduct searches and seize evidence, including property or instruments believed to be related to the offense.
Can they make arrests?
Yes, they can arrest and detain persons suspected of MLTF, especially if there's a risk they might abscond or destroy evidence.
For how long?
Well, those detained must be presented to an adjudicating authority within 24 hours for remand. And that remand can be extended, according to this act, for up to 90 days, usually in 30-day increments.
And freezing assets.
Absolutely. They can freeze or seize laundered property, instruments used in offenses, or property related to terrorist financing. And this can often be done ex parte.
Ex parte.
Meaning, without prior notice to the person involved, it's a powerful tool to prevent assets from disappearing the moment someone gets wind of an investigation.
And this applies even internationally.
They actively pursue freezing assets in foreign countries, too, through international cooperation mechanisms. The reach is intended to be global.
That sounds incredibly powerful. But what about a situation where someone isn't necessarily caught red-handed, but they're just living this incredibly lavish lifestyle, and their declared income simply doesn't seem to match their visible wealth?
This is a really insightful provision in the Act we reviewed. It tackles exactly that.
How so?
If a person is prosecuted for MLTF, and they possess property, maintain an unbelievable lifestyle, or have made donations or loans that are way beyond their apparent capacity compared to their declared income, they are required by law to provide the legitimate source of that property or those funds.
So the burden of proof shifts.
Effectively, yes. The legal burden shifts to them to prove the legitimacy of their assets. Any property for which the source cannot be proven shall be confiscated.
That's quite a tool.
It is. It's designed to catch those who appear to be getting away with it simply by enjoying their illicit gains without an obvious direct link being immediately apparent.
And the big question, what are the ultimate penalties for these offenses if someone is convicted?
The penalties are severe, as you'd expect, reflecting the gravity of the crimes. For money laundering, individuals face imprisonment from 2 to 10 years.
Okay.
And a fine equal to twice the claimed amount involved if that amount can be ascertained.
Twice the amount laundered. Wow.
Yes. And for terrorism financing, it's even harsher. Imprisonment from 3 to 20 years.
Longer sentences.
And a fine equal to 5 times the claimed amount involved, or a very large fixed sum, like 10 million rupees in this act, if the amount isn't clear.
5 times?
And just abetting these offenses, helping someone else do it, carries half the punishment.
What about companies? Legal entities?
Legal persons, like companies, can face penalties up to 5 times the prescribed punishment for individuals. They can also be prohibited from public procurement contracts, have their registration canceled, or even face liquidation.
So destroy a company.
Absolutely. And importantly, officials within those companies who are found to be perpetrators or were in charge and negligent can also face additional personal penalties on top of the corporate ones.
Right, piercing the corporate veil again.
Exactly. Accountability at all levels.
We touched on international cooperation earlier, especially freezing assets. How does the Act ensure properties and funds are frozen across borders, particularly concerning terrorism?
Yeah, this is where global collaboration becomes absolutely essential. The system described involves the Ministry of Foreign Affairs promptly publishing lists of terrorists, terrorist groups, or organizations designated under UN Security Council resolutions.
So keeping up with UN sanctions lists.
Precisely, ensuring real-time updates domestically. Then, the Ministry of Home Affairs issues immediate freezing orders for any properties and funds linked to those designated entities within the country.
Immediate freezing.
Yes. And they also actively handle requests from foreign countries to freeze assets of suspected terrorists located within their jurisdiction, showing that commitment to global security.
Who has to comply with these freezing orders?
Critically, natural persons, legal persons, government agencies, and all reporting entities are obligated to immediately freeze these properties, without delay and without prior notice to the targeted individual or group.
No tipping them off.
Absolutely not. And there are also clear processes outlined for delisting someone if they're wrongly identified, or defreezing funds if circumstances change, following established procedures.
Okay. Now, with all this reporting, STRs, TTRs, and investigations going on, are there protections for those who provide information, like the reporting entities themselves or maybe whistleblowers?
Yes, and this is a vital aspect to encourage reporting. It's really important.
How so?
The Act states clearly that no criminal, civil, disciplinary, or administrative action will be taken against government agencies, reporting entities, or their officials and staff who, acting in good faith, submit reports or provide information as required by the Act.
Even if it breaks other secrecy laws?
Yes, this protection applies even if it technically breaches secrecy provisions under other laws, like banking secrecy. It gives them a legal shield against retaliation for doing their duty under the AML CFT law.
That makes sense. But is there a flip side? Like telling the customer you reported them?
Yes, there's a very strict tipping off prohibition.
Tipping off.
Meaning reporting entities or their staff cannot disclose to their customer or any other third person that a suspicious transaction report or a threshold report has been submitted or that an investigation is underway or might be initiated.
Why is that so crucial?
It's crucial to prevent suspects from altering their behavior, destroying evidence, moving assets, or fleeing justice once they know they're under scrutiny.
And if they do tip someone off,
violations can lead to significant fines for the reporting entity itself, or departmental action, like disciplinary measures for the officials involved. It's taken very seriously.
are there any unique provisions that stand out to you in this act? Perhaps surprising elements that maybe balance the strict enforcement we've discussed?
Yeah, there are actually two provisions that are quite notable, I think.
Oh.
First, there's a reward mechanism. Individuals who file a complaint, provide information leading to an investigation, and cooperate fully can potentially receive a reward.
A financial reward.
Yes, potentially 10% of the claimed value recovered, or up to a certain limit, like 1 million rupees in this act, whichever is lower if the allegation is ultimately established and assets are confiscated.
Interesting. An incentive for whistleblowers.
Exactly. It's a strategic incentive to turn people into active participants in the fight against financial crime.
And the second provision.
The second is, well, a fascinating humanitarian aspect, you could say. If all of an individual's assets are frozen during an investigation, and they genuinely have no other means of livelihood for themselves or their dependents, the court may order the investigating department to release a nominal expense portion of the frozen assets, just enough for basic living conditions, food, shelter.
Really? Even for someone suspected of serious crimes?
Yes. It shows a thoughtful balance, perhaps, between the need for strict enforcement and asset freezing, and acknowledging basic human rights and needs, even for those under investigation before conviction.
That is quite notable. Okay, so let's try and pull this all together. What does this all mean when we connect the dots? Today, we've really peeled back the layers on a comprehensive legal framework using this specific national act as our lens, but seeing how it reflects global standards designed to combat money laundering and terrorist financing.
Yeah.
We've seen how a global body like FATF sets the standards, how different national agencies like the FIU and the Specialized Department work together,
That coordination is key.
and how this really wide range of reporting entities, from banks, yes, but also to casinos and real estate agents and lawyers, are essentially on the front lines,
Definitely the front lines.
tasked with identifying suspicious activity and fulfilling these really stringent KYC and due diligence obligations.
And if we connect this to the bigger picture, it just highlights this constant ongoing arms race, doesn't it? Between criminals trying to hide their illicit gains and governments establishing increasingly sophisticated systems to detect and prevent financial crime.
It's a constant battle.
It really is. the sheer breadth of those predicate offenses we talked about and the granular details required for customer identification, it just underscores how pervasive and complex these challenges really are.
Yeah.
It's a battle fought through regulations, through data analysis, through international cooperation, and just constant vigilance, constantly adapting to new threats and new methods.
This deep dive truly reveals the immense, multifaceted effort required to safeguard the global financial system from abuse. It really makes you wonder, though, given the constantly evolving nature of financial technologies, crypto, fintech, AI, and criminal tactics adapting just as fast, how long will frameworks like this, even comprehensive ones, remain fully effective? And what's the next frontier in this seemingly endless global fight against illicit finance?
That really is the crucial question, isn't it? In a world where financial transactions are increasingly digital, increasingly decentralized, and instantly borderless, how will regulations continue to adapt and evolve?
Right.
How can they effectively